Hello and welcome to the Deep Dive. Today we're taking an in-depth look at a company that's quietly, and well, maybe not so quietly, shaking up the global beverage industry, MiXUE. For those of you who follow market trends and want to understand the unique forces driving success in the fresh drink space, this deep dive is definitely tailor-made for you. But before we get into it, don't forget to hit follow, like, and share to support our team. And speaking of industry shapers, think about this for a second. Where do you actually get a refreshing iced tea? Or, a simple, delicious ice cream cone for just a few dollars these days? For decades, the global standard for affordable, accessible treats might have been McDonald's, right? A true behemoth with a presence in almost every corner of the world. But now, if you're in Asia, or increasingly in cities further afield, the answer you're hearing more and more often is MiXUE. Today, we're embarking on a fascinating deep dive into MiXUE, the company that recently made huge waves with its listing on the Hong Kong Stock Exchange, and is, well, fundamentally redefining the low price segment of the global fresh drink market with its incredibly affordable and pervasive offerings.
That's absolutely right. Our mission today is to thoroughly unpack this really intriguing company for you. We'll trace its surprisingly humble beginnings, from a tiny stall right up to its global dominance. We'll dissect its incredibly innovative and frankly quite disruptive business model. We'll also analyze its impressive financial performance and peer into its ambitious future plans, especially, in the wake of its recent IPO. And we'll examine how the market has reacted to this fast-growing giant. We've synthesized all the sources you've shared, market analyses, company reports, you name it, to uncover the crucial insights, basically giving you a comprehensive shortcut to understanding what truly makes MiXUE tick and why it's become such a global phenomenon.
So whether you're prepping for a crucial meeting and need to sound expertly informed about global F&B trends, maybe catching up on the latest market disruptors, or you're just insanely curious about how a company can sell ice cream for $1 and still become one of the world's largest F&B chains, well, get ready for some serious aha moments. This isn't just a story about beverages, it's really a profound case study in disruption, extreme economies of scale, and I guess the power of a brilliantly executed low-price strategy. Okay, let's pull back the curtain then and truly unpack this company's origin story. Because when you realize how it started, it makes its current global leadership all the more astounding. This isn't your typical Silicon Valley startup tale. It's quite the journey from incredibly humble beginnings.
It absolutely is.
Yeah.
And it's really a testament to perseverance and, well, some incredibly shrewd business sense. MiXUE was founded way back in 1997 by a visionary entrepreneur named Deng Hongkao. This was in Zhengzhou, which is a bustling city, but maybe often overlooked, in China's Henan province. And forget sleek cafes or venture capital seed funding. Zhang Hongkao started this whole enterprise as a tiny, really unassuming shaved ice stall. Just try to picture it. A simple wooden cart, a few basic ingredients, and a dream, the initial capital. It actually came from his grandmother's life savings, a mere 3,000 yuan.
Wow, 3,000 yuan.
Yeah, which even back then was a really modest sum, maybe equivalent to a few hundred US dollars. The early days were just a relentless grind. Zhang Hongkao himself came from a poor rural family, even dropped out of middle school. He tried various odd jobs before sort of stumbling upon the potential in affordable desserts. He faced constant experimentation with products, lots of trial and error, and significant challenges, just keeping the business afloat. It reflects a very raw, grassroots struggle for survival in a highly competitive street food environment.
Okay, but here's where it gets really interesting, because that period of intense struggle eventually led to like a watershed moment, right? A strategic pivot that changed everything. The year was 2006, and China was buzzing with the excitement of the upcoming Beijing Olympics. Apparently, there was this popular, somewhat premium-priced, cone-shaped ice cream designed to look like the Olympic torch that appeared on the market, selling for nearly 20 yuan, which was quite a lot for a simple ice cream back then.
Right.
Zhang Hongkao, with his keen eye for opportunity and, I guess, a deep understanding of the mass market, saw this not just as a trend, but as a direct challenge and a massive opportunity. He quickly developed his own low-priced alternative, meticulously formulating a recipe that allowed him to offer a similar, high-quality ice cream cone for an astonishing 1 yuan.
1 yuan, compared to 20.
Exactly. To give you some context, that's nearly a 95% price reduction compared to the trending product. This disruptive pricing strategy wasn't just a sale, it was like a revolution. It instantly propelled the brand into the national spotlight, making it synonymous with incredible affordability and unbeatable value. Can you imagine the impact? A delicious 1 yuan ice cream when competitors were charging 20.
It must have been an instant sensation, democratizing a simple pleasure for millions, really. That 1 yuan ice cream was undeniably a game changer. It established MiXUE's brand identity around, extreme affordability. However, it also highlighted a critical vulnerability. Ice cream sales are inherently very seasonal.
Ah, right. Colder months.
Exactly. Zhang Hongkao recognized this early on. He understood that relying solely on ice cream meant significant revenue fluctuations and, well, idle capacity during colder months. So, MiXUE smartly diversified. By 2013, they expanded aggressively beyond just ice cream, strategically focusing on other popular year-round fresh drinks like bubble tea and lemonade. But they didn't just casually add these to the menu. They went to extraordinary lengths to optimize these new offerings for cost-effectiveness and mass appeal.
Like the lemonade example.
Precisely. Take their lemonade. They literally taste-tested lemons globally to perfect their signature Eureka lemon flavor. This involved a meticulous, almost scientific process of screening lemons for specific criteria: the ideal weight, precise sugar content, optimal juice yield.
Wow.
Yeah. This deep dive into raw material selection wasn't just about taste. It was about ensuring consistent quality and, crucially, optimizing costs right at the source. This strategic diversification was absolutely critical. It transformed their business from a seasonal treat vendor into a sustainable, robust, and year-round operation.
And how did they manage to scale so fast, going from a single stall to this multi-product powerhouse?
Well, just a year after that one Yuan ice cream became a national sensation. So in 2007, MiXUE started adopting a franchise model.
Okay, the franchise route.
And this wasn't just a good idea. It became the absolutely crucial engine for their rapid and widespread expansion across China and eventually, globally. It allowed them to grow without needing massive, direct, upfront capital investment for each new store. They effectively leveraged the entrepreneurial drive of thousands of local business owners.
Right, tapping into local capital and ambition.
Precisely. And what's truly remarkable is that they achieved this initial explosive growth without requiring any external financing whatsoever.
Really? Self-funded?
Completely self-funded initially. This, especially in the capital-intensive food and beverage industry, is almost unheard of for a company scaling at this pace. And the numbers just speak for themselves. By 2014, only 7 years after embracing franchising, they had already hit 1,000 stores.
Okay, 1,000 stores by 2014.
Then fast forward just 6 more years to 2020, and they had surpassed an astounding 10,000 stores. They were primarily dominating the lower-tier cities and rural markets across China at that point. This strategic focus perfectly aligned with their low-price strategy, tapping into these vast, underserved consumer bases.
And today, MiXUE is no longer just a Chinese giant. It's a truly global player, arguably the biggest in the F&B space by store count. Right?
By store count, yes. As of December 31st, 2024, they boast an astounding 46,479 stores.
46,000. Let that number sink in for a moment. This isn't just incremental growth. This is staggering, almost unprecedented expansion. These stores are primarily located across mainland China, forming an incredibly dense network, but they also have a significant and rapidly growing presence in cities across 11 overseas markets now. We're talking a substantial footprint across Southeast Asia, Indonesia, Vietnam, Malaysia, but also in places like Australia, Japan, and South Korea. This scale makes them the largest F&B chain worldwide by store count. They've surpassed long-established giants like McDonald's,
which has around 43,000 locations globally.
and Starbucks with about 40,576. This isn't just an achievement, it's really a fundamental shift in the global F&B landscape.
And that remarkable journey, from a 3,000 yuan shaved ice stall to a global leader, culminated in a significant financial milestone. The company successfully listed on the Hong Kong Stock Exchange, the HKSE, on March 3, 2025. This IPO didn't just raise capital. It cemented their status as a major public entity, endowing them with a substantial market capitalization of HK $52.7 billion by March 7, 2025.
HK $52.7 billion.
Wow. For a company that began so modestly, this listing is a powerful testament to their unique strategy, operational efficiency, and, well, that explosive growth trajectory.
Okay, so we've seen the incredible journey and the sheer scale of MiXUE, but the question remains, how do you make money selling ice cream for $1 and still become a multi-billion-dollar company? That's the real magic trick, isn't it? Let's dig into the sophisticated engine that powers this affordability and dominance. What's the secret sauce?
Indeed. MiXUE's unparalleled success is rooted in what we call its unique heavy back-end, light front-end business model. This isn't just a buzz phrase. It's the core strategic innovation that underpins their entire operation. The heavy back-end refers to their massive, multi-billion-dollar investment in what most companies would typically outsource. Their raw material procurement, their sprawling network of highly automated production facilities.
The ones that make the syrups and tea bases.
Exactly. Transforming those raw materials into proprietary ingredients. And also their incredibly sophisticated logistics network that delivers these components. They own and control virtually every step of this supply chain. In contrast, the light front end is the customer-facing aspect. Those simple, low-cost, high-volume franchise stores. As of September 30, 2024, more than 99% of their nearly 47,000 stores are franchised. That's run by an impressive 19,780 franchisees, a substantial leap from just 6,366 in early 2021.
Okay, almost all franchised. But the crucial insight here, which might surprise many, is their primary revenue model, right? It's not what you'd typically expect from a franchise.
Exactly. Unlike many franchise operations that primarily earn from royalty fees or a percentage of sales, MiXUE operates very differently. And this is where their heavy back-end truly shines. Over 90% of their revenues come not from the drinks sold to customers, but from selling store supplies. Ingredients like syrups, milk, tea, coffee, fruit, grains, and packaging materials directly and exclusively to these vast numbers of franchisees.
So they're essentially the mandatory supplier to their own network.
Precisely. Less than 10% of their revenue comes from equipment sales, initial franchise fees, or ongoing management fees. This fundamentally changes the dynamic. MiXUE acts as the exclusive supplier. Their profitability is therefore directly tied to the sheer volume of materials they move through their system.
Which creates a powerful incentive to keep prices low for the end consumer.
Exactly. Lower prices drive higher sales volume for the franchisees.
Which means higher material orders from MiXUE.
It's a brilliantly self-reinforcing ecosystem. And this model directly feeds into their multifaceted competitive edge, which collectively forms a really formidable economic moat against competitors. First, there's their low-price strategy, which we've touched on. MiXUE's products are generally priced incredibly low, typically between 2 and 8 yuan in China, or below RM10 in overseas markets like Malaysia.
So like pennies or a couple of dollars US, roughly.
Right. A glass of their signature lemonade costs around 4 yuan, and an ice cream cone is about 3 yuan. This is dramatic contrast to competitors like Heitia or MiXUE's tea, whose comparable drinks often start at 16 yuan or even higher.
A huge difference.
This strategy isn't about premiumization. It primarily targets the mid to low end, or, as they call it, the sinking market. It attracts a truly massive base of price-sensitive consumers, students, blue-collar workers, lower-income individuals. By offering such high cost-effectiveness, they maximize market share and build strong consumer stickiness. Customers aren't just buying a drink, they're getting incredible value. The inherent challenge, though, is maintaining profitability with such slim margins on individual products. Which brings us to their next and perhaps most critical pillar.
Right, the enabler. And that leads directly to what you've called their real secret. It's not just about selling cheap. It's about how they can sell so cheap and still be incredibly profitable and scale globally. And that, as you've highlighted, is their extreme supply chain management. This truly sets them apart and must be incredibly difficult to replicate.
Absolutely. This is the industrial engine that drives everything at MiXUE. It begins with their global procurement network. MiXUE procures raw materials at an absolutely massive scale, leveraging their immense volume to negotiate superior deals. They consistently achieve prices 10% to 20% below their peers for key items like milk powder, tea leaves, coffee beans, and of course their famous lemons.
Okay, 10–20% cheaper just on raw materials.
Yeah, and they don't just buy from suppliers. They engage in deep vertical integration. They establish their own companies directly in raw material production areas. For instance, for their Eureka lemons, they've set up operations in Taiyang Village, Sichuan. This allows them to directly cooperate with farmers, effectively cutting out layers of intermediaries, ensuring consistent quality control from the very source, and securing long-term, stable, and cost-effective supplies. This direct sourcing strategy is paramount to their low-cost advantage. Then there are their production bases. MiXUE operates 5 large-scale, highly automated production facilities strategically located across China, in Henan, Guangxi, Chongqing, and Anhui. These bases boast an impressive annual capacity of about 1.65 million tons. They're equipped with over 60 intelligent production lines, using advanced automation, robotics, digital tools.
So highly efficient manufacturing.
Extremely, producing a vast array of proprietary, cost-effective food ingredients and packaging materials, everything from syrups and fruit concentrates to specialized tea bases and ice cream powder. This extensive self-production capability is a huge differentiator. It helps them reduce their raw material costs to around 30% of sales revenue.
Only 30%. Compared to what for others?
Well, the industry average often ranges from 45% to 55%, so it's a significant saving.
That's a massive difference.
Yeah, this remarkable efficiency directly translates to their ability to maintain those aggressive low retail prices while still generating healthy profits at scale.
And it's not just about efficiently making the ingredients, right? It's getting them to nearly 47,000 stores across vast geographies quickly and consistently. Their logistics system must be incredibly robust.
It absolutely has to be. They operate a highly sophisticated network comprising 27 warehouses and an incredibly extensive delivery system. It covers over 40,000 stores in more than 300 cities, 1,700 counties, and 4,900 towns in mainland China alone.
The reach is just phenomenal.
It is, and they leverage advanced digital tools and a centralized management system to synchronize the flow of goods, information, and funds seamlessly. This integration ensures fast, reliable delivery, often within 12 hours for most domestic locations.
12 hours, that's impressive. It's critical. This unparalleled logistical efficiency means franchisees receive fresh supplies quickly and affordably, which is key for consistent product quality across the entire network and for keeping operational costs low at the store level. The sheer complexity and scale of this end-to-end supply chain sourcing, production, distribution creates massive economies of scale. This isn't just an advantage, it forms a very high barrier to entry for competitors. It's incredibly difficult, almost prohibitively expensive, for any new or existing player to replicate this level of vertical integration and cost efficiency.
Right.
This truly positions MiXUE as a supply chain company first that happens to operate a hugely successful beverage brand rather than just a beverage brand with an outsourced supply chain. It's their core identity. That vertical integration and supply chain mastery sound like an impenetrable fortress for their operations. But what about the softer side? In such a high-volume, low-margin world, how do they build customer loyalty, especially when they're not relying on premium pricing or exclusive experiences? Is there a secret beyond just being cheap?
Absolutely, and this brings us to their brilliant strategy of brand IP building. In 2018, MiXUE introduced Snow King.
Ah, yes, the mascot.
Exactly. A fantastic, instantly recognizable cartoon character that acts as their lifelong ambassador. This wasn't just about creating a cute logo. It was about building an entire emotional ecosystem around the brand. Snow King isn't just a static mascot. It's dynamic, engaging. It engages audiences through a highly catchy theme song.
I think I've heard that song. It's everywhere.
It really is. It has garnered an astonishing 9.7 billion views across various social platforms, one of the most recognizable jingles in China for sure. Beyond the song, there are countless short videos featuring Snow King that go viral, appearances at major music festivals, and even a popular animated TV series, The Legend of Snow King, which has amassed over 220 million views since its debut in August 2023.
Wow, an animated series.
Yeah. Plus, you see costume Snow King characters regularly interacting with consumers at store openings and events, creating memorable, shareable moments. And there's a wide range of branded merchandise, plush toys, cups, stationery.
So it's a whole multimedia franchise, basically.
Kind of, yeah.
Yeah.
This strong, unique intellectual property fosters immense brand awareness, creates a deep emotional connection with consumers, particularly younger audiences, and builds remarkable loyalty. In a fiercely competitive, low-price segment where products might seem interchangeable, Snow King differentiates MiXUE. It turns a simple purchase into a fun, memorable experience. It injects personality and joy into an otherwise, utilitarian transaction.
Okay, now let's shift gears and look at the financial performance. How has this unique and incredibly efficient model, powered by that industrial-scale supply chain and the beloved mascot, how is it translated into actual growth and profitability? This is where the numbers really tell the story.
Right, and MiXUE has demonstrated truly robust revenue growth over the past few years. It's a clear indicator of their expanding footprint and increasing sales volume through that massive franchise network. Their revenue surged from RMB 10.4 billion in 2021 to a remarkable RMB 20.3 billion in 2023.
Almost doubled in 2 years.
Pretty much. That represents an impressive 40.05% compound annual growth rate, or CGR, over that 2-year period. This rapid revenue expansion is a direct consequence of their aggressive store expansion and the high volume of supplies they sell to their ever-growing franchisee network.
And despite their low-price strategy, which you'd think would mean slim margins, their gross profit margins have remained surprisingly robust.
Surprisingly robust, yes.
Yeah.
Hovering consistently around 30% during the same period.
30% gross margin on $1 ice cream. That's impressive efficiency.
It's a direct reflection of their extreme cost control and operational efficiency within their supply chain. It has led to a significant increase in gross profits, climbing from RMB 3.2 billion in 2021 to RMB 6.0 billion in 2023.
Again, almost doubling.
Yeah, it's a powerful indicator of how effectively they manage their input costs and production processes, allowing them to capture substantial profit even with those low retail prices.
Okay, but what about net profit? Did that follow the same trend?
Well, their net profit margins did see a slight decrease. They moved from 18.5% in 2021 down to 15.7% in 2023.
Okay. Any reason for that dip?
Yeah, it's important to understand the context. This dip was largely attributable to increased headcount, hiring more people as they grew, and also higher selling and distribution expenses. This makes sense as they continued their aggressive expansion, particularly internationally, and invested in building out their operational infrastructure.
Right, costs associated with rapid growth.
Exactly. However, despite this slight margin compression, the sheer scale of their operations meant that profits attributed to shareholders still grew substantially. From RMB 1.9 billion to RMB 3.1 billion in 2023. It demonstrates that even with increased investments for future growth, the underlying growth momentum of their business model is incredibly powerful, enabling them to generate substantial and increasing absolute profits.
And we have an immediate update on their most recent performance, right, which continues to underscore this trajectory.
Yes, absolutely. In the first 9 months of 2024, MiXUE's profits surged an impressive 45.2% year-on-year to RMB 3.5 billion. That's approximately US $483 million.
45% profit growth year on year. Wow.
Their net profit for this period increased by 42.33% to RMB 3.49 billion. And get this, to give you a concrete sense of their volume and market penetration, they sold an astounding 7.1 billion drinks during those 9 months alone.
7 billion drinks in 9 months. That's almost unbelievable volume.
It's staggering. And revenue for the third quarter of 2024 alone increased 21.1% year-over-year to RMB 18.7 billion. These are truly huge numbers that showcase their continuing robust growth trajectory and their ability to generate significant cash flow, even if the overall revenue CAGR has slightly moderated compared to those earlier hypergrowth phases.
Makes sense. And did they give any guidance for the full year 2024?
They did. The company provided a clear profit estimate for the full year 2024 of not less than RMB 4.4 billion. That translates to approximately HK $4.8 billion. Based on this robust projection, their estimated earnings per share, or EPS, would be around HK $12.73.
Okay, HK $12.73 estimated EPS for 2024.
Right. These figures highlight a company that is not just expanding rapidly in terms of store count and revenue, but is also generating substantial and consistently increasing profits. That's precisely what long-term investors look for. It paints a very compelling financial picture.
With that strong performance and impressive financial health, what are MiXUE's plans for the future? Especially now that they've successfully gone public and have access to significant capital from the IPO. It's clear they're not just sitting back, right? They're reinvesting.
You're absolutely right. They are definitely not resting on their laurels. The IPO, which aimed to raise HK $3.29 billion, or about US $444 million in gross proceeds, outlines very clear and strategic allocations for this substantial capital. These aren't just vague plans. They represent precise investments back into the very core competencies that have propelled their success so far.
Okay, so where's that money going?
Firstly, a significant portion, 45% of the IPO proceeds, is earmarked for expanding their production capacity within China. This means constructing new facilities at their Hainan production base between 2023 and 2025. These new facilities will be specifically dedicated to producing key inputs like frozen fruit products, coffee products, various syrups, and other condiments. Furthermore, they have planned construction for new facilities at their Hainan production base over the next 2 to 4 years, focusing on essential components like ice cream powder and milk powder production.
Adding more capacity for core ingredients.
Exactly. This expansion alone is projected to add an impressive 80,000 tons of yearly production capacity to their already massive existing capacity of 1.21 million tons. This shows a deep and continuous commitment to reinforcing their heavy back-end supply chain, ensuring they can meet demand as their network grows and continue to drive down per-unit costs through even greater economies of scale. It's about building an even more robust and efficient manufacturing backbone.
So they're basically doubling down on their self-production capabilities, which makes total sense given how absolutely crucial that vertical integration has been to their cost efficiency and their ability to maintain those low prices. It's a fundamental reinvestment in their core competitive advantage.
Exactly. And beyond bolstering production, 9% of the IPO proceeds are allocated for significantly improving their logistics systems within China.
Mm.
This isn't just about adding more trucks. It involves strategically enlarging their storage capacity in key distribution hubs, expanding their geographical coverage to reach even more remote and lower-tier areas across China.
Getting that 12-hour delivery everywhere?
Precisely. And continually enhancing their delivery efficiency across their already extensive domestic network. Maintaining that highly competitive 12-hour delivery promise is paramount to franchise satisfaction of fresh product delivery. This investment will help ensure they can do so reliably and cost-effectively as they continue to grow.
Okay, so strengthening the domestic machine. What about internationally?
Right. What's particularly critical for their global ambitions and a very strategic move is the allocation of 12% of the proceeds to establishing an international supply chain platform. With around 5,000 stores already operating successfully in Southeast Asia, primarily in Indonesia, Vietnam, Malaysia, and Thailand, this investment is strategically vital for their long-term global vision.
5,000 stores already outside China.
Yeah, it's significant. The plan is to set up a multifunctional supply chain center directly in the Southeast Asian region. This will allow for the direct supply of ingredients and materials to their overseas franchisees, crucially bypassing the need to ship all supplies from their production bases in China.
Ah, a regional hub. That's a big step.
It's huge. This move will undoubtedly improve efficiency, significantly reduce shipping costs and transit times, enhance the responsiveness of their international operations to local demand, and allow for greater regional customization and quality control. It's a major step towards truly localizing and optimizing their global supply chain.
That international supply chain center sounds like a massive step in cementing their global footprint, truly transforming them into a multinational operation rather than just an exporter of their Chinese model. And they're also investing in something less tangible, but equally important, right? The brand.
Indeed. Another 12% of the IPO proceeds is dedicated to branding and intellectual property, or IP, building. This means continuing to expand the Snow King content matrix, all the animated series, short videos, music collaborations, theme song efforts, and intensifying their omni-channel marketing efforts across various platforms.
More Snow King everywhere.
Pretty much. The goal here is to deepen their brand influence globally, leveraging the emotional connection and widespread recognition that Snow King has already garnered in China. It's about ensuring that the brand's unique identity continues to resonate with consumers, even as they expand into new cultural landscapes with different marketing norms and preferences. This investment ensures Snow King remains a powerful, engaging asset for brand loyalty and differentiation in new markets.
Okay, makes sense. And the rest?
Finally, 10% of the proceeds shall be reserved for general working purposes. This allocation provides crucial financial flexibility for unforeseen needs, capital expenditures, or maybe to capitalize on new opportunities that arise unexpectedly. Gives them agility in a fast-moving market.
It's clear they're investing heavily back into the very supply chain and brand that made them successful, effectively strengthening their competitive moat. They're not just expanding, they're reinforcing the foundational pillars of their unique, vertically integrated model. It seems like a very disciplined approach to capital deployment. So given all this, the incredible growth, the ingenious business model, the strong financial performance, and these ambitious future plans, how did the market react to MiXUE's IPO? Was there as much enthusiasm from investors as there is from consumers for their cheap treats?
The market reaction was, well, extraordinary, almost unprecedented for a company of this type in recent memory for the Hong Kong market. MiXUE's initial public offering on the Hong Kong Stock Exchange on March 3, 2025 wasn't just successful, it was overwhelmingly so. The retail tranche, that's the portion for individual investors, was oversubscribed by an astounding 5,258 times.
5,000 times oversubscribed. Seriously.
Seriously, to truly grasp the magnitude, imagine for every single share MiXUE offered to the public, over 5,000 bids came in. This wasn't just high demand, this was a market frenzy. It signals an almost unparalleled level of confidence and excitement among the general public. It even surpassed the loan amounts generated for major IPOs that ultimately didn't proceed, like Ant Group's and Kuaishou Technologies.
Yeah, that's just an absolutely incredible level of demand. So what happened when shares actually started trading on day one? Did that enthusiasm translate into a strong price performance?
It certainly did. Shares opened at HK $262. That was already a significant 29.3% jump from their offer price of HK $202.50.
A nice pop right at the open.
Yeah, a very strong signal of institutional and retail appetite. And they didn't stop there. By the end of their debut day, shares closed up a remarkable 43% at HK $290. This significantly outperformed the benchmark Hang Seng Index, which only saw a modest 0.3% gain on the same day.
Up 43% on day one.
Okay. That opening price alone valued the company's Hong Kong-listed equity base at HK $99 billion, or approximately US $12.7 billion. This clearly indicates immense investor confidence and a strong market appetite for MiXUE's unique growth story and proven profitability. It's a powerful statement for the market.
Any analyst takes on this?
Yeah, analyst Kenny Wen from KGI Asia, a respected voice, noted that even with this spectacular rally, the performance was, and I quote, still below our expectations.
Below expectations after a 43% jump.
It might sound surprising, yeah.
Yeah.
But it reflects just how massive that oversubscription was. And MiXUE's incredibly strong underlying fundamentals, healthy margins, growing revenue.
Yeah.
He specifically emphasized that MiXUE's strong reception could significantly help shore up the broader IPO market this year, suggesting the successful listing could inspire more companies to go public in Hong Kong, breathing new life into the market.
Interesting. So it shows that even in tougher market conditions, a compelling story can really fly.
Exactly. It demonstrates that despite broader sentiment or economic headwinds, compelling fundamentals and a clear growth story can still attract significant, even overwhelming investor interest.
That's a huge vote of confidence. What about ownership structure now? And any potential future payouts for investors? Who retains control, and what's their stance on dividends, especially for a company that seems to be in such an aggressive growth phase?
Right, so Zhan Hongkao, the founder, and his brother, Song Hongfu, remain the largest shareholders. Collectively, they hold a substantial 41.7% of the shares through their respective entities.
So still firmly in control.
Definitely. This means they retain significant control and a vested interest in the company's long-term performance. Zhang Hongkao serves as the chairman and executive director, focusing on MiXUE's overarching corporate strategy and culture. His brother, Zhan Hongfu, is the CEO and executive director, overseeing the company's daily operations and management, ensuring smooth execution. Their cousin, Xipeng, is also a minor shareholder involved in China operations.
Okay. And dividends.
As for future payouts, currently, MiXUE does not have a formal dividend policy in place.
Not surprising for a growth company.
No, it's common. It suggests the company is prioritizing reinvesting its profits back into aggressive growth and expansion, solidifying the supply chain, expanding production, building out that global footprint. For investors, this implies that the immediate return is expected to come from capital appreciation rather than recurring dividends, as profits are channeled back into business development.
Got it. Reinvesting for growth.
Exactly. And based on that estimated 2024 EPS of HK $12.73, investors can derive its PE ratio, which offers a sense of its current valuation relative to its robust earnings.
Okay, this picture of rapid growth, impressive scale, a strong market debut, and a clear reinvestment strategy is compelling, no doubt. But as with any deep dive, it's crucial to explore the complexities and potential headwinds. What are some of the challenges and considerations that MiXUE faces as it continues its relentless expansion? No company, no matter how successful, is without its hurdles, right?
You're absolutely right to raise that. While MiXUE holds an incredibly solid and dominant position, particularly in China's low-end fresh drink market, the ready-made tea beverage industry itself is still relatively new in its development history, especially compared to coffee or traditional soft drinks. And it is fiercely competitive. The market pattern is still evolving. It's far from finalized. This means the competitive landscape can shift rapidly.
New players, changing tastes.
Exactly. New entrants emerge. Consumer preferences are fickle and can change quickly. Existing rivals like Gumming, Chapanda, or even higher-end brands like Nayuki and Heitiu, who are constantly innovating and sometimes adjusting their own pricing strategies, they constantly pose threats. MiXUE's success invites competition, and they must remain agile.
And there are inherent risks built into their unique franchise model too, right? Despite its advantages for rapid expansion.
Definitely. The reliance on such a vast and geographically dispersed network of franchisees, nearly 47,000 individual business owners, means there's a constant potential for inconsistencies. Inconsistencies in management level, operational capabilities, product quality, service across different locations. This significantly increases the difficulty of quality control for the parent company.
Yeah, I can imagine. Ensuring consistency across 47,000 stores must be a nightmare.
Think about the complexity. Ensuring a store in a remote county in China upholds the exact same standards as one in Shanghai or even overseas in Indonesia. A single food safety scandal, a poorly made drink, or a viral customer complaint from just one rogue franchisee could rapidly tarnish the entire brand's meticulously built reputation, especially now with social media.
Right? Bad news travels fast.
It puts an immense and continuous burden on their oversight and quality control teams, requires constant vigilance and robust training.
What about challenges specific to China or internationally?
Well, domestically, the company is facing a slowing growth rate in what is becoming an increasingly saturated and highly competitive Chinese market. While still growing, that hypergrowth of earlier years is naturally moderating as market penetration reaches higher levels. They've also, like many large food and beverage chains operating at such scale, encountered food safety issues in the past. These can range from minor slip-ups to more significant concerns.
Yeah.
While often resolved quickly, they pose a recurring reputational challenge for any company with such a vast footprint. Internationally, while their expansion has been impressive, localizing their model and adapting to diverse consumer preferences, cultural nuances, and regulatory environments will present ongoing challenges.
Yeah, what works in one place might not work elsewhere.
Exactly. What works brilliantly in China or Southeast Asia might need significant adaptation for, say, the highly competitive Japanese market or the more established Australian market. This adaptation could impact their cost structure, speed of expansion, and even the core appeal of their low-price model in regions where consumer expectations differ.
Another interesting point that came up in the sources relates to their R&D strategy. It seems MiXUE's R&D investment is notably lower than some competitors, like Gumming or Haiti.
That's correct. It's a fascinating strategic trade-off.
So they're more focused on replicating trends efficiently than inventing new ones.
Largely, yes. They benefit hugely from quickly identifying and replicating popular trends, then mass-producing them at an unbeatable price. You could argue, why invest heavily in inventing the wheel when you can perfect its manufacturing and distribution?
But the question is that sustainable long-term? What happens if the market fundamentally shifts and demands truly original innovation?
That's the potential risk. If a competitor disrupts with a uniquely patented product that captivates consumers, or if consumer tastes shift rapidly towards novel offerings beyond just affordability.
Then MiXUE might find itself playing catch-up.
Potentially, yes. It could impact their differentiation beyond just price. It's a calculated gamble that has paid off handsomely so far, but definitely one worth watching closely.
Okay, so wrapping things up.
Right. In conclusion, MiXUE's phenomenal success is really a powerful testament to its masterfully executed business strategies. These include that unique heavy back-end, light front-end franchise model, an aggressive low-price strategy dominating the mass market, and that highly efficient, vertically integrated supply chain almost unparalleled in the industry for its scale and cost-effectiveness. And on top of all this, they've built powerful brand IP around Snow King, creating a unique emotional connection. Essentially, MiXUE is an incredibly efficient supply chain empire disguised as a popular milk tea and ice cream brand. It's built a formidable economic moat that's extremely difficult to replicate. In many ways, their scale advantages and cost leadership resemble those seen in giants like Coca-Cola or McDonald's, but built from the ground up with this lean, franchise-driven model.
And despite some inherent internal challenges like managing slowing domestic growth and the risks of that huge franchise network, plus external pressures from intense competition and international localization, MiXUE's financial performance remains robust. Their ambitious expansion plans, especially that strategic investment in an international supply chain, signal a company that is not just poised for, but actively driving continued disruption in the global beverage market. They are clearly leveraging their IPO proceeds to further strengthen their core advantages and broaden their reach.
So the ultimate question for investors and consumers alike, as MiXUE continues its extraordinary global journey, is this. In an increasingly premiumized and diversified global market where novel experiences and high-end offerings often grab headlines, can MiXUE's affordable luxury model, built on extreme efficiency, an unbeatable price point, and a beloved mascot, can it not only maintain its current dominance, but also truly resonate and expand successfully into new global territories? Can they do that without compromising their core values of affordability and accessibility, or encountering significant pushback from established local players who might also adapt to the low-price segment? It certainly offers a fascinating, compelling, and potentially groundbreaking case study in business strategy, global expansion, and, well, the enduring power of value.
If you want us to cover any other stocks or dive into another fascinating industry trend, just let us know. We love hearing from you and digging into what makes companies tick. And again, don't forget to follow, like, and share to support the show. Thank you.